Good morning. I would like to begin by acknowledging that we are in Treaty 1 territory and the traditional homeland of the Métis Nation. My name is Carrie Linklater. I'm your chairperson today. On the panel with me is Lynn Nesbitt and Bob Upton. Our city assessor is Kem Wong, and our administrative secretary is Kara Belshaw. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that applicants or the assessor make at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by City Council and is independent of it and the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board. The matter pertains to assessed value or classification, or to the Court of Queen's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the matters to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the order by registered mail as soon as possible, and as information, all public hearings are live streamed, recorded, and will be part of the public record.
Will you swear in or please state your name?
Ken Wong.
Do you affirm the evidence you present is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. Will you swear in on the Bible or affirm without?
Necessary.
It is necessary to do one or the other. Please state your name.
Pete Dolman.
Do you swear the evidence you present today is the truth, the whole truth, and nothing but the truth, so help you God?
Right.
Thank you.
Good morning, Mr. Wong and Mr. Dominic. And we'll start with Mr. Wong whenever you're ready.
Sorry.
Take your time, that's fine.
Okay, the subject property is 661 Roche Street, roll number 020-411-07000. It's a residential apartment block that's 2 stories high. It was built in 1958, but would have an effective year built in 1978. There are 5 suites, 4 outdoor parking stalls. On page 2 is the sales history of the subject property. In 2011, it sold for $450,000. On page 3 is our income valuation summary. We use average rents of $871 to get a potential income of $52,000. We use the 2.6% vacancy to get an effective gross income of $50,000, and we use a 42% expense ratio to get a net operating income of $29,000. Capped at 4.4%, we have an estimated market value of $669,000, which is $133,000 per unit. On page 4 are our rent comparables, showing that the rents we've used are in line with what's on the market. On page 5 is a summary of the income and expenses submitted by the owner. The estimated NOI is about $33,000, which is a little bit higher than what the model is estimated at $29,000. On page 6 and 7 is information on how we derived our cap rates. So would I be able to speak with the applicant for a few minutes?
Yeah. Yep, you want to step outside?
Sure.
Yeah.
Yeah, please.
Yep, I'm just going to show you this, thank you. And I would like to bring this meeting back to order. Mr. Wong, the floor is yours.
I guess I've presented some information on what the model is estimated in terms of value, but actually having reviewed the applicant's information, I'd like to provide a recommended, a revised value of $560,000.
And that would be based on?
The information that the applicant provided.
Sir,
Yes.
you're in agreement with this
Oh,
recommendation?
yeah, absolutely, yes. I'm
Okay.
sorry.
That's fine.
Focused.
Thank you.
That's it.
That's it? We're all good? Well, so I do have other properties. Is there a way to do this for other ones, so I don't have to go through all this? Like how do I know who the assessor is to maybe deal with this ahead of time next time?
No, let's get this switch around and I'll just.
Sure.
When the time is up, I'm just kind of curious.
The secretary will be happy to help you.
Thank you very much. Thank you. Have a good day.
You too.
Yes.
Do you want to,
Is it possible for
I
us
gather
to
Mr. Sanderson is not here.
not, to the best of my knowledge, he is not.
Would it be possible to switch the order that?
It's up to Mr. Newman.
I'm okay. He's promised me how long he'll be.
Do you have,
He's timing.
do you have the stopwatch out?
I will.
So we're switching it up?
Yeah.
Okay, sounds good.
Mr. Wong, you're all right with that?
Yeah.
So we are going to move to 1354 Place.
Please state your name.
Trevor Smith.
Do you swear the evidence you present today is the truth and nothing but nothing but the truth so help you God?
I do.
Thank you.
Good morning, Mr. Smith.
Good morning.
Mr. Wong, whenever you are ready.
The subject property is 1354 Fight Street. The roll number is 050-040-775-00. It's a residential apartment block that's 2 stories high. It was built in 1977 and it has 14 suites with 14 outdoor parking stalls. On page 3 is our income valuation summary. We use average rents of $811 to get a potential income of $136,000. We use a 3% vacancy to get an effective gross income of $132,000. We use a 60% expense ratio to get a net operating income of $52,000. Capped at 4.7%. We have an estimated market value of $1,126,000, which is $80,000 per unit. On page 4 are our rent comparables, showing that the rents are in line with the market. On the bottom of page 4 are some expense comparables showing that the expenses for typical apartment blocks like this are from 43 to 53%. So the market expenses are a little bit lower than what we've applied for this property. On page 5 is information on how we derive our cap rates. The cap rates range from 4% to 7.3%, with the majority of them falling between 4.9 and 5.3%. On page 6 are some cap rate sales. The cap rate sales range from 4 to 6%. They're primarily there to substantiate the accuracy of the model. And there's the sale at the bottom at 500 Portage, which is 4.07%. On page 8 is the income statement provided by the owner. The owner is Manitoba Housing and Renewal Corporation, so it is affordable housing. I don't think using the affordable housing financials would lead to very accurate estimates of market value, because these financials they're not market, they're affordable housing. On the last page are market rents provided by CMHC. For the area, the subject, which is 14 2-bedrooms, the average 2-bedroom rent from CMHC is $1,053. In this particular case, the model is estimated below market, a market rent at the low end of the range at $811, and it's applied a 60% expense ratio, which is higher than what market typically is, which might be around 50%. So for the subject property, we used rents that are of a below average apartment building. The expenses that have been applied are higher than average, so we've reflected this property as a as a below average apartment building, and the cap rates are in line with what's on the market. So I ask you maintain the assessment at $1,126,000.
Thank you. Mr. Smith, questions?
Yes, the market value today, this is all model driven, is it?
I believe so. I'm not 100% sure.
Okay. The page number 6, 500 Portage Avenue sale at the bottom there, that is the Colony Square property, is it not, across from University of Winnipeg?
Yes.
Okay, so it's a significant tower, there's an office component to it, main floor retail, a parkade as well.
Yep.
Okay. And the expense comparables that are on, on page number 4, what, are they towers, walk-up apartments, or do we know what those are?
I do not know.
Okay, those are all of my questions, thank you.
Thank you. Mr. Upton?
Yes, your cap rate at 4.7 is at the lowest of your scale.
Yes.
Is this appropriate for a 1977 building? I know there's other factors besides age, but
Yeah, I believe it is appropriate because when we look at some of the sales of the smaller size buildings and the smaller blocks, they seem to be trading at a lower cap rate. And so I do believe that it is appropriate, and when you apply these cap rates to the operating incomes of smaller blocks, they, from my experience, they give accurate estimates of market value. So I believe it is appropriate.
have you inspected this building?
I've not.
Okay, just wanted to ask about the condition, but you wouldn't be aware of that. Okay.
No.
Thank you. Good for me, thanks.
No, those are the questions I had as well.
Mr. Wong, did you prepare this brief?
Yes.
Page 4 on your expense comparables, are those Manitoba housing properties? Do you know?
No, they are not. They're market apartment buildings.
So this building has an actual of 1977 and an effective of 1977. So you don't know if anything has been refreshed? I'm assuming this is original, given the years stated?
I don't know. Sometimes work is done without our knowledge. As far as I can tell, we don't have an effective age variance, so I guess we haven't seen any major work. But
Okay, and as stated, you did not inspect the property. Can you tell me the last time somebody from the city inspected it?
no.
Okay. Thank you, that's all my questions. Mr. Smith, if you'd like to proceed.
Yes, thank you. So 1354 Fife Street, this is a Manitoba housing property. If you flip to my page number 9, you can see the location of the property. It's just north of the Inkster Park industrial area. As you can see from the photo there, property was built in 1977 and is comprised of 14 two-bedroom townhome units. It has not been refreshed since that time frame. If you flip to page number 4, we have our photographs of the property itself, so to the exterior. Then you can see the very basic nature of the finishes inside, the flooring obviously being original, cabinetry in the kitchen, stairwells, bathroom, wood frame windows that are in need of some TLC, obviously, as you can see, and the common areas, all to the Manitoba housing standard of that time, very basic accommodation, and probably in slightly below average condition. and obviously in the original build-out. Moving on to the valuation side of our property today. We looked at the valuation as done by the city of Winnipeg, and ultimately we're in agreement with the rental income and the expense allowance percentage in this case. Again, we're looking at townhomes here. So for properties such as this, each unit will have their own systems that will require replacing, that being hot water tanks, furnaces, etc. You have individual, you have more roof area, etc. for the same number of units, so, and obviously more grounds generally as well. So typically operating expenses are higher on townhomes than they are on standard market apartments. So in this case, we feel that the expense allowance at 60% is appropriate. We have included some laundry revenue. There was, it's either laundry or parking. I don't know if I was able to determine from the income and expense form that we had received on the subject property. So we have a property that would be in slightly below average condition, original to 1977. We have deferred maintenance. We have a location just to the north of the Inkster Park industrial area. And I'm not going to go through my text that we've all heard several times, I think, on the panel with regard to social housing and the issues with regard to purchasing of those properties, capitalization rate selection, the risks that are involved for any purchaser. I trust that we all recall that particular argument. It is on page number 13 for you to review. With regard to cap rate, on page number 13, I would ask everybody to, for the moment, disregard the comparable number 2. We're doing some further background research on that particular property, and it may indeed get pulled from our cap rate chart. Looking at our other comparables, we have a low of 5.44% up to a high of 6.65%. Now, obviously, there's variability between these individual properties that sold and the subjects that we compare it to, but this is an indication of the investment market and what investors are willing to pay for properties and the resultant cap rates based on properties that were purchased for the in-place income. There were no further renovations to these buildings following sale, as they had already been either renovated or were not in need of renovation. So these are true cap rates. So we're in that 5.5% to 6.5% range. If we look at the market participants, they're mimicking this. Their cap rate ranges are in that 5.25% to 6%, 5 to 6% for low-rise properties, as stated by Colliers in both the 2016 and 2018 timeframe. They're essentially saying caps have not changed in that time frame, which is what we're seeing in the market. If you look at C.B. Richard Ellis, they're exactly the same, indicating low rises are between 5.5% and 6% for A's and 5.75% and 6% for B's. Now, the subject property is a townhome. There is no category for that. There's very, very few trades of townhouse properties on the marketplace. Typically, they are in lower demand, and there is obviously more operating expense and more systems and more capital that tends to be needed to be spent on these particular properties. C.B. Richard Ellis is indicating essentially a flat line with regard to cap rates. So looking at the subject property, we have townhomes, which are in lower demand. We have an original property that has not been changed, significant deferred maintenance, located just north of Inkster Park. We have capped it at 6% at the top end of that standard range. And This gives us our final market value of $897,000. The addendum materials include the income expense, the industry reports, and then we have some decisions from other Manitoba housing properties that are supportive of our capitalization rate at the back of the brief. And I'm open for questions.
Thank you.
Thank you.
Mr. Wong, questions?
Yes, for your evaluation, essentially you're using the assessment department's information except for the cap rate.
We looked at the information that the city arrived at, and we felt that it was a fair indication of the net operating income for the subject.
I have no questions.
Okay, thank you. Mr. Upton?
No, I have no questions, thank you.
I have no questions.
So, you inspected this property?
I did, yes.
And you yourself, not one of your colleagues?
I did, yes.
Okay, thank you. And you said you felt this property was below average?
It would be slightly below average, yes.
And this is 14 suites. How many of the suites did you look at?
I believe we saw 2 of the units.
Okay. Because page 6 of your brief, at the top, the kitchen has all its drawers and fronts.
That particular one does, yes.
Okay.
Not all of them are
Right,
torn off.
Right.
Yeah.
Page 7 of your brief, at the top, you've got the windows. Were most of the windows in this condition?
Well, that's, they tended to be fairly worn, yes, and they were the original wood frames.
So you are in agreement with the city's NOI?
More or less, yes. We added in either the parking or laundry revenue, so I think our NOI is ever so slightly higher than the city's, but it's, for all intents and purposes, either one is fine by me.
Thank you.
Thank you.
All my questions. Mr. Wong? Sorry, Mr. Wong, I'm assuming neither of you want a summation on this property, or?
No, that's fine.
Oh, I was just gonna say, just basically say what I said previously with
Okay.
with regards to, you know, we've treated this property as if it was below average. The rents that we've applied are below what's on the market. The expenses that we applied is higher than what's on the market. And so we've captured the sort of below averageness of the property in the rents, and typically a lot of it is captured in the rents. And so, and the cap rate that we've used is in line with what's on the market. And also, with regards to the approach that the applicant has taken to sort of, you know, agree with certain parts of what we presented, and then to maybe disagree with the last part being the cap rate. I'm not sure if that's appropriate to take, you know, an approach from one organization and then take certain parts of it and then apply it to, you know, your own valuation. The valuation that we've provided is sort of our own, and I feel it's appropriate.
I guess I'm doing a summary then.
Yeah, sure.
So my, to speak to that, the property is in below average condition. So when you're looking at the valuation, you look at each individual component and what would it rent for on the market in the state that it is, where it is, et cetera. Will it rent for less than the market norm? Yes, it will. So that's appropriate. It's a townhome, again, in the condition it is, higher costs for townhomes, it's going to have a higher expense ratio. That's appropriate. That doesn't deal with the cap rate, that's an entirely separate issue. We do not see sub-5 cap rates in the marketplace for properties as is, where is. That is the purchase of a property for another purpose, where you're not buying that property, you're buying what you're going to change it into and the resultant revenue. So anything sub 5 is simply not based on the property as is, where it is, which is what we're valuing today. We're not valuing any potential future changes that one might do to a property. That's what the legislation is, and that's what we're intended to follow. So to include cap rates that are not representative of purchase of the actual NOI from a property is not appropriate.
Okay, thank you. We will move on to the next property, Bismarck Street. Mr. Wong, whenever you are ready.
Subject property is 100 Bismarck. The roll number is 090-055-62000. It's a residential apartment block that's 2 stories high. It's built in 2010 and has 12 suites with 4 indoor parking stalls and 8 outdoor parking stalls. On page 3 is our income valuation summary. We use average rents of $1,098 to get a potential income of $158,000. We use a 3% vacancy to get an effective gross income of $153,000. And we use a 38% expense ratio to get a net operating income of $93,000. Capped at 4.5%, we have an estimated market value of $2,081,000, which is $173,000 per unit. On page 4 are our rent comparables, and the rents we used are in line with what's on the market. On page 5 is a summary of the income and expenses that were provided by the owner. Their estimated net operating income is about $99,000, which is a little bit higher than what the model is estimated at $93,000. On page 6 is information on how we derived our cap rates, and on page 7 are some cap rate sales. You see the sale of 333 Ward worked out to about $174,000 per unit, which is very similar to what the subject property is assessed at. On page 9 is a picture of the subject property with its location. On page 10 are some pictures of the subject property from the internet. On page 11 to 15 are the income statements provided by the owner. So when you look at the actual performance of the property, it supports the model, and I ask that you maintain the assessed value of $2,081,000.
Thank you. Questions, Mr. Smith?
Yes, just a couple. Looking at your page number 5 and your reading of the income and expenses and the resultant NOI that you arrive at there. So for 2017, You deducted the miscellaneous expenses of $56,490 that the owner had indicated in their I&E, correct?
Yes.
No other adjustments beyond that?
No.
Did you look at the expenses and whether they were at market norms or not? For instance, 2015, would $20,000 in expenses be a normalized ratio?
Is at about 32%, and what I've seen is that it can range from about 26% to 43% for newer buildings.
Okay. What I'd asked about was 2015, so you have 3 years here, and you're indicating a result in NOI, so the expenses shown that you have for that year are $20,000. Does that seem to be a normalized amount? It's roughly
No.
20,000 higher than the other 2 years that you have down there?
No, that's why for the stabilizing of the NOI, I only used the 2017 expenses, which seemed a little bit more in line with market.
Okay, but you did not look at it beyond taking out the 56,000 in miscellaneous
No.
expenses, correct? Okay. Has any further research been done on the cap rate sales that are shown on page 7 since the beginning of our hearing cycle here?
No.
Okay. Those are all of my questions, thank you.
Thank you. Mr. Upton?
This is all model driven then, and did you override it somewhat then?
I believe it's all model.
All model. So you didn't override the model by
I don't believe so.
the actual expenses or report from the owner? Didn't?
I don't believe so.
Just straight model, okay. Did you inspect this property?
No, I did not.
Okay, thank you.
Ms. Lisbon?
Yeah, can you comment on the cap rate? I just note that for this property, you've used a 4.5. It's a 2010 building. Looks like it's in pretty good condition from your pictures.
Yeah.
Don't know how old they are, but.
Yeah.
And the previous one used a 4.7 cap for 1977 Manitoba housing property.
Yep.
So I'm just sort of having a difficulty even looking at how the model has used a cap rate.
Yep.
That's really very similar to the MHRC property.
It might be similar, except I guess this one's built in 2010,
Yeah.
and the other one is built in 1977. So it does have the 1977 property does have a higher cap rate than this newer building.
Of 0.2,
Yes,
yeah.
yeah.
Kind of not what I would have anticipated, given there's, almost 35 years, almost 40 years of difference in age.
Yeah, yeah. The cap rates, they might not go as much into by age as one might think. Based on some appraisals that I've looked at, there's been appraisals that have used sales of buildings that were built in 1959 to 1979 for a building that was built in 2010, say. So they're using cap rates from that are much older than what the actual subject property is. And so there might not be as much difference between, say, a 2010 building and a 1977 building, but there is a small difference. And I believe that's what we've shown here. And the 4.5 and the 4.7 cap rates, from what I've seen, they do estimate the value accurately as far, like, when I look, based off of some of the information that I've seen, based off of some of the sales that I've seen. So, the reason why this one's a 4.5 and the other one is a 4.7, I think is just primarily because of the age, but it is lower because of it's smaller in size.
Okay, and I missed the numbers that you provided on the expense ratio. You've given us 38.96, pretty much 39.
32%.
You gave a range that you felt was.
Oh, yeah.
And what was that range that
It was
you
about
said
26% to about 43%.
for this age of property?
For newer buildings, yes.
Okay, so 20, sorry?
About 26 to
42.
43 from what I've seen.
Okay, thank
Yeah.
you. Thank you, that's all.
Thank you. So, Mr. Wong, you did not inspect this building.
No.
Can you tell me, do you have in your notes when it was last inspected? I'm assuming because it's a 2010 build, it has been inspected in the last few years?
Uh, 2010, when it was built. It was, that's when it was inspected, when it was added to the roll.
Okay. Do you have anything on permits for the building?
No.
Because I'm assuming page 2 is a land sale?
Yeah, well, whether it was a land sale or not, it may as well have been a land sale.
Yeah. That's all my questions.
I have
Mr.
some,
Smith?
I have some very brief rebuttal, exceptionally fast.
Thank you.
So this is with regard to the city's cap rate evidence on page 7. So the city is a member of the IAAO. The document that we're looking at the beginning here is the standard on verification and adjustment of sales. If you flip to 5.10, it's the first page with text on it, property characteristic changes. I'll just read very briefly here. It says, sales data files should reflect the physical characteristics of the property when sold. Ratio studies of significant physical changes have occurred to the property between the date of sale and the appraisal date of the sale should not be included. Following that, it says, the sale may still be valid for mass appraisal modeling by matching the sale price to the characteristics that existed on the date of sale. So this reads somewhat residentially, thinking of has there been upgrades to the house, etc. But the point for investment properties is, has the property been renovated post-sale and the income adjusted? Now, what we're indicating here is that 3 of the properties that are included in the city's chart on page 7 were purchased for renovation, were subsequently renovated, and then their incomes increased. Therefore, they do not meet the guidelines of the IAAO and should not be included in the ratio study. They would be included in the city's cap rate study as they're being presented here. And as we all know, there's been many properties that were purchased to be renovated and have their income increased. So very quickly, there's the information that's publicly available on 3 of these properties. The first one being 191 Roche. You can see that it was purchased for renovation and was subsequently renovated. You can see the low level of the rents when it was purchased. And we have 394 Talbot, where we have information from the property manager indicating that it was purchased for renovation. Following page, also regarding 394 Talbot, indicates that the rents at the time of purchase were $537 for the 1 beds and $653 for the 2 beds. These have subsequently changed to $800 and $900. Significant difference in the return to the investor. And we have at the very back 285 Maxwell. Again, email from the property management firm indicating that it was purchased with the intent to renovate and was being renovated and the rents increased over a 3-year time frame. The very last page indicates the rents at the time of purchase, $652 for 1 beds and $725 for 2 beds. The 1 beds are now going for $966. So you can clearly see the effect on the revenue to the property and the resultant return to the investor. So the point of this is that the cap rates that are being included in the study as presented by the city and their evidence should not be included in the ratio study and skew the model downwards because of their inclusion. And that's my rebuttal. Thank you.
Thank you. Mr. Wong, questions?
I guess maybe not necessarily questions, but just sort of response.
Okay, go ahead.
I just thought that, like, the, on his page 12 for 191 Roach, the owner is indicating a cap rate of 5%, and we have a cap rate of 4.84. So it is very close to what the owner has estimated in terms of a cap rate for the property. With regards to the intent to renovate, the cap rate is like in the previous municipal board decisions, they've pretty much indicated that the board does not accept any intention to renovate should disqualify a property sale. So in the end, like, these cap rates are good estimates of market value, and from what we've seen, they are good estimates. And so that's regarding the renovations. But also with regards to the IAAO standards, the department does meet IAAO standards. Like I guess we're certified by them with regards to our model. So how we approach it does meet their standards. And as from the same document that Mr. Smith got his information from, part of the sales verification, the sales should be verified to determine whether they reflect market value of the real property transferred. These sales, they do reflect the market value. Sales are excluded only when they fail to meet the requirements of an open market arm's length transaction. They meet those requirements. And also, as Mr. Smith stated, the sale, the ratio study, for ratio studies, if significant physical changes have occurred to the property between the date of sale and the appraisal date, the sale should not be included. The sale may still be valid for mass appraisal modeling by matching up sale price to the characteristics that existed on the date of the sale. So I feel that, you know, we do meet IAAO standards and the municipal board.
Okay.
Yeah. So that would be my response, and that would be.
So you've just given a little summation there then, so, okay.
Yeah.
Did you have any questions?
I have no questions.
Okay. Mr. Upton, did you have questions of Mr. Smith?
Further rebuttal?
Okay, no, and neither do I. You would like to finish your presentation?
Okay, thank you. So 100 Bismarck, built in 2010. We're looking at 12 two-bedroom units. Property was appealed in 2019 and reduced, as you can see on my page number 3. We've appealed this decision to the municipal board and it's awaiting scheduling. that reduction was to $1,736,000. Subject property photographs are on page number 4 and onwards. It is relatively recently built in 2010. It's of good quality, but not luxury finishes by any means, as you can see from the photographs. It's still in good condition, obviously. Further description on page number 8, and the site is shown on page number 9. It's at the corner of Pandora and Bismarck. So if you head up, I guess it's Plessy, and take a right on Pandora, you will come to the property. Now, we didn't include a photo of it, but directly across the road, and we get a good indication of this on page number 10, directly across the road from the subject across Pandora is the main CN rail yard. So it stretches, I don't know, 3, 4, there's a building that's roughly 2 or 3 blocks long immediately across from it. So that is what you're looking at on one side. Moving on to the valuation itself, the property generated at full occupancy, it would generate $146,423 in rental revenue in 2017. That being net of vacancy, so no vacancy, pardon me, vacancy already taken out of that figure. This equates to a monthly rental rate of $1,017 per unit for the 2-bedroom units. We've given you our rental comparables at the bottom of page number 12. Tried to keep them in the same area, obviously 2 bedrooms, and we've included the detail with regard to the units there. Perhaps the most comparable property or comparable properties would be the Tupelo at the bottom, and the Molson is also a more comparable property as well. They have in-suite laundry, storage, dishwasher, as does the subject. So those are similar in nature and location. The CMHC stats are on page number 13. Transcona rental rate for 2 bedrooms averages $920. We're well above that at the subject property at a little over $1,000 a square foot. Parking for the property is included in the lease rate. Moving on to the expense side, as noted, we've used the actual revenue net of vacancy for the subject property. They did not have vacancy for the property for that time frame. We have not applied it. On the expense allowance, if you look at the bottom of page number 14, the property reported expenses of $103,111. This was over 70% of effective gross income, well above a normal range of operating expenses. We're not using the full expenses. Obviously, there needs to be an adjustment there. In order to have a reasonable estimate of expenses, we have deducted the expense amount of $56,490 that the owner had included as miscellaneous expenses, as if we were unable to determine what that included. Certainly there may be items in there that would be appropriate for inclusion, but we don't know what they are. What we did do is we adjusted the repair and maintenance line item, as it was well below what one would expect in the marketplace. It was $544 a suite. We have adjusted this to $800 a suite to reflect a more appropriate repair and maintenance cost for a property such as this. This changes your R&M upwards slightly, as you can see in the text there, and brings our expense allowance to $49,698. feet, which is just under 34% and is well below what the city's estimate is. Our cap rates remain the same on page number 15. As to the market studies indicating capitalization rate ranges for low-rise in that 5.25% to 6% range roughly. Now, the subject property, our most recent sale of a relatively recently built property is the 333 Ward property. Obviously, there's differing information being put out on this. In the hearing, which either occurred this week or last week, I believe both the city as well as the owner's agent were in agreement that the cap rate based on in-place net operating income was 5.25% for that property. The intent and knowledge of the purchaser was such that there were efficiencies to be had, and the cap rate was actually 5.44%, which is actually how the property is operating now. That's the background on that. We see 5.5 essentially being an appropriate cap rate for a property that is relatively recently constructed, in good condition, etc. Is this as good a location as 333 Ward in South St. Vital, in the corner of St. Mary's? Probably not. However, we have capped it at 5.5%, and this gives us our final market value of $1,759,000. Thank you.
Thank you. Questions, Mr. Watt?
No questions.
Mr. Upton?
Yeah, so basically your difference here is cap rate. You agree to a higher NOI than what the assessor has shown?
Correct.
So it's really cap rate we're talking about?
It is, yes.
Yeah. And your 5.5 is, pardon me, your cap rate of 5.5 is derived from your table on page 15, you say? That's an example of cap rate.
It's based on our market information there, yes.
These are
You know,
basically old,
frankly, it
these are
could be
very old.
5.25, it could be 5.5, but it would not be below either of those levels. I would accept 5.25. Certainly anything below that I don't see as being realistic in the market. As I stated, there are no cap rates based on in-place revenue of below 5% that would be supported in the marketplace.
These are basically very old buildings, except for the one.
Yes, but they had been.
Going back to 1906.
They had been renovated prior to sale. The 430 Young, which is the one you just mentioned there, please disregard that particular sale as we're doing further background research on that.
Okay. Okay, that's fine, thank you.
No questions. You had a chance to inspect this property?
I have, yes. In the last cycle, actually, I did not view it for 2020, but it has not changed since that time.
I believe you stated this is not a luxury property,
No,
given the state, location, et cetera, across from this CN anyone?
yes, just north, not the line, but their production building. So right across Pandora is their long, tall building that they work on the trains, I presume.
Okay.
It's their main yard.
And you view this as a negative or a positive?
Well, I mean, I guess there's 2 points. You could work at CN, so you're close to it, but in terms of visual aesthetics, it's not great. And Pandora is a relatively busy street because of all the people going to work there.
Okay. That is all my questions. Thank you.
Thank you.
Just gonna take a quick 5-minute break. Right, Kara?
For the weekend. Please state your name.
Mark Newman.
Do you swear the evidence you present today is the truth, the whole truth, and nothing but the truth, so help you God?
I do.
Thank you. Thank you.
Good morning, Mr. Newman.
Good morning.
Mr. Wong, whenever you are ready. We are looking at 1861 Main Street.
The subject property is 1861 Main Street. The roll number is 110-009-47000. It's a residential apartment block that's 2 stories high. It was built in 1960 and it has 22 suites with 12 outdoor parking stalls. On page 3 is our income valuation summary. We used average rents of $620 to get a potential income of $163,000. We used a 3% vacancy to get an effective gross income of $158,000. And we used the 49% expense ratio to get a net operating income of $80,000. Capped at 5.3%, we have an estimated market value of $1,521,000, which is $69,000 per unit. On page 4 are our rent comparables, showing that rents we've used are in line with what's on the market. On page 5 is a summary of the income and expenses submitted by the owner. Their estimated operating income is about $76,000. It's a little bit lower than what the model is estimated at $80,000. On page 6 is information on how we derived our cap rates. They range from 4 to 7.3%, with the majority of them falling between 4.9 and 5.3%. On page 7 are some cap rate sales to substantiate the accuracy of the model. On page 9 are some pictures of the subject property with its location. The last pages are the income and expenses submitted by the owner. The actual performance is a little bit lower than what the model has estimated. But it is pretty close, it is in line with what the model has estimated. And the cap rate is in line with what other similar properties are for this. So I ask that you maintain the assessed value at $1,521,000.
Thank you. Questions, Mr. Newman?
Yes. So page 1, the actual year built is 1960, the effective year built is 1960. So as we sit here today, this is essentially a 60-year-old building. Page 5, this is a summary of the actual income and expenses. And as you've noted, the stabilized net operating income is at $76,481, is about $4,000 less than what the model is generating at $80,616, correct?
Yes.
And the expenses, did you calculate the average of those expenses, those stabilized expenses? Let me rephrase. Did you calculate the percentage that the stabilized expenses are of the revenue?
No.
Okay. If I tell you I've calculated it and it's 53.9%, you can check that, but I'm telling you that's what I've done.
Sure.
Turn to your page 6, please. So, and I'll say to the panel, I'm going to ask a series of questions about capitalization rate. I'm going to ask them once. I don't intend to ask them on all the appeals. But the assessment on this property is model driven, correct?
Yes.
And the city's model says that the capitalization rate should be 5.3%,
Yes.
correct? I have a sense from prior hearings that the city's model is influenced to some extent by age. Do you agree?
Yes.
But it's also influenced by size.
Yes.
And I have a sense it's more influenced by size, and by that I mean the number of units, than it is by age.
I'm not sure about that.
Okay, we're gonna come to a later property, which is much smaller, but we'll talk about that when we get there. So, you've got the chart on page 6, and what you're telling us is that in multifamily, the city's analysis says that low-rise A and low-rise B, and low-rise at the 80th percentile, they're all at 5.3%. Correct?
No. They're not all at 5.3.
Well, the chart says at the 80th percentile, it's all at 5.3%.
Well, it's just saying the majority of the properties have a cap rate of 4.9 or 5.3.
Sure.
Yeah.
And what I was putting to you was that at the 80th percentile,
Yeah.
it's saying it's 5.3%.
Okay. Yeah.
That makes no distinction for the age of a property. It treats all properties, without regard to their age, as being the same. Agreed?
I'm not sure about that.
Okay. And then the broker reporting, Colliers is reporting a range of 5 to 6 for low-rise buildings. CBRE is reporting 5.5 to 6 for what they call A, and low-rise B are 5.75 to 6. Do you know what the difference is between a low-rise A and a low-rise B?
So I guess some people's definitions differ.
Do you know though?
Mm, mm, No.
Okay.
We treat the capitalization rates for the city are, do not distinguish between the low-rise A and B or high-rise or low-rise.
In other words, no qualitative distinction is made, that's what you're saying.
With regards to high-rise or low-rise or A or B.
Right. So they're all treated the same without regard to their quality, and that will include without regard to their age. Agreed?
It would be difficult for me to say for sure.
Okay. Do you know, and I'm gathering the model makes distinctions, it groups properties into categories based on their age. Do you know where the breakpoints are for those ages?
I guess the ones that I can think of are approximately 1946 and 1975.
So 46 to 75 would get a 5.3?
I guess, it depends. I'm not totally sure.
And I'm asking...
It does, I'm sure it does vary a little bit. And so
Right.
for me to say, which age category, which location gets 5.3 or maybe a 5.1 or a 4.9, for me to say where those different cutoffs are, I probably really have to look into it, but I definitely don't know that.
All right. Let me ask you this. Does the neighborhood factor into the setting of the capitalization rate in any way?
The location.
Okay, so the answer is yes. Okay. And in part, Mr. Wong, in fairness to you, I'm asking these questions because I've been a participant in a hearing where Jennifer Martins gave evidence, and she was able to explain to some extent these age variants and the categories that properties fall into. All right, so then when you go to page 7, these capitalization rates are brought forward not to assign to a specific property, but to provide support for the validity of the model.
Yes.
Okay. And the first 3 properties in the multifamily table, Roach, Talbot, and Maxwell, my understanding is that these properties were all renovated subsequent to the sale. You understand that as well?
From the information that I've seen, yes.
Yes. And you saw it from Mr. Smith before, but Altus has brought it forward. It's been brought forward multiple times, correct?
Yes.
Okay. And a more general question. When people buy investment properties, my sense would be that they buy them for 2 reasons. They buy them to get a return on their investment, and I'll call that a yield. Would you agree?
Yes and no.
Okay, which part is yes and which part is no?
Well, I mean, it's difficult for me to say what a purchaser, I guess, is interested in. They could be looking for a yield from the actual income, or they could be looking for a yield based off of the amount of money that they put in.
Okay. Okay. All right, I'll leave it there. Those are my questions. Thank you.
Thank you. Mr. Upton?
I think they've been asked, thank you.
Thanks, me too.
Just one question. Did you have a chance to inspect this property?
No, I did not.
Do you have in your notes when the last time this property was inspected?
No.
Do you have anything in your notes in regards to condition?
No.
Okay. Thank you. That's all my questions. If you'd like to proceed, Mr. Newman.
Thank you. And I'll just mention to the board as I start that this property and the next one, 1881 Main, they are literally across the street from each other. A lot of what you're going to hear in the context of my submissions on this property will be the same on the next property as well, and I'll then try and abbreviate it. So, 22-unit apartment building built in 1960, therefore it's 60 years old. No elevator in this building. I do not quarrel with the net operating income, but I am going to make comments about the actual NOI, where the actual, as the assessor has noted on page 5 of his brief, is $76,481. The model kicks out an amount some $4,200 higher at $80,616. I'll also point out that the expense ratio the assessor is utilizing is 49.29%, and the assessor's stabilized expense ratio is 53.9%. So notwithstanding the calculation by the assessor on page 5 of his brief of a stabilized expense ratio and a stabilized NOI, no adjustments have been made to the model. That's okay with me in the sense that I'm prepared to accept the net operating income, but I do have comments about the capitalization rate, and these things feed into those comments about the capitalization rate. I say to you that I think 5.3% for a 60-year-old building like this is too low, and I want to talk with you a little bit about the world of apartment buildings. I have spent a lot of time talking to property managers and owners of apartment buildings who have been very, very active in this field. If you go back in Winnipeg, 2 things have happened in Winnipeg over the last 5 to 10 years. Firstly, especially in the last 5 years, you've had a lot of new construction. The supply of apartment buildings has increased considerably, apartment units. You've had a lot of construction in the condo world. and a lot of those condos have, I use the word, leaked into the apartment rental pool. That's happened because interest rates were very low, and I've got some material relating to those interest rates. If you go to tab 1 of my material, the last 2 pages of tab 1, these are the prime rate and bank rate as published by the Bank of Canada. So what you see on page 12, for example, is the prime rate. If you look along the left-hand side of the page, middle down, you've got date, 2016-04, so that's April of 2016, and the rate was 2.70, and then circled above that, I've got April 1 of 2018, the rate was 3.45%. If you turn the page and look at the bank rate, you'll see the bank rate at 2018, April 1 is 1.5%, and you'll see that at April of 2016, it was 0.75%. Why do I tell you this? Because I tell you this so you will understand that going back to 2008 and the economic issues that arose then, a lot of liquidity was poured into the financial markets by central banks. That continued in Canada, but as we got to 2016, what I'm going to call the lows were reached, and there's been an increase in interest rates because there's been a belief by central banks that interest rates need to increase or inflation will get out of control. The reason that's important in the context of investments is that bond rates and interest rates, they are the engine that drives real estate, because people borrow, they leverage, and the only reason I'm telling you all this is because I know the department is of the view that there's been a compression in capitalization rates, and I say to you, I don't believe there's been a compression in capitalization rates for a number of reasons. One, interest rates have increased, not decreased. Two, the supply of units in the marketplace has increased, not decreased. More units leads to higher vacancy, leads to higher turnover costs. I know, again, from my clients who I discussed this with extensively, you go back 5 years, an apartment unit came vacant, you might truly fill it within a week or 2 weeks. Effectively, you had a zero vacancy. That has dramatically changed. You get a lot of turnover in buildings, and that leads to lost rent, but it also leads to higher turnover costs. You've got to paint units, you've got to clean a carpet, you've got to do a variety of things. So what I'm telling you is that the market for the apartment world that was characterized by low yields available on safe investments, people didn't want to go to the stock market. There was a great flight to real estate. Unprecedented low interest rates, low availability of product, those things have changed. Those things aren't there anymore. The bank rates are part of the evidence of that. Go to my tab 2. And in my tab 2, I've actually got parts of the Altus cap rate study, but there's a reason why I put it there, which I will explain to you. If you go to page 4 in the lower right-hand corner, there's a heading Apartment Universe. And these are statistics which are taken from the CMHC reports. And the 2017 report indicates that the number of units available was 57,407 units. Go back to 2014, it's 53,975. Go back to 2011, it's 52,319. So effectively, over the 4 years, you've seen a 5,000 unit increase in the number of apartment units available in the city. That creates the kinds of issues I've described to you earlier and leads to an increase in vacancy, but it also, I suggest, has not led to a compression in capitalization rates. If you go to my tab 1, the first page is the city's chart from the 2018 assessment, and I've got some things circled. the 20th and 80th percentiles for the various buildings. And for 2018, it was 5.25 and 5.5 across the board at the 20th percentiles. In 2020, if you go to the next page, the chart is now telling us, the city says it's 4.9 and 5.3. If you look at what the brokerage firms were reporting, go back to 2018 chart, page 1, you can see that Colliers were reporting 4.75 to 5.75 for high-rise and 5 to 5.75 for low-rise. Remember with Colliers, and I've got the excerpt from the municipal board hearing where this evidence was given, they include in their sale price the closing costs. The effect of including in the sale price the closing costs is to decrease the capitalization rate. Mr. Rocky Neufeld, a member of the Colliers firm, has been heard to say on many occasions that that's marketing, because they can market to the investors, to the purchasers, that capitalization rates are low. But again, nobody else does it that way. The point is, however, that in 2018, that's what Colliers says the cap rates were. CBRE said they were 5.5 to 6 for low-rise A and 5.75 to 6 for low-rise B. And then if you go to 2020, you can see that the brokers, Colliers is reporting 5 to 6 more generally, so their rates are up, not down. And CBRE are reporting 5.5 to 6, same as they were before. And all of that to evidence the fact that I do not believe that a compression in capitalization rates is occurring, as I know the department will suggest. So, having said all of that to you, where does that lead us to? Investors buy buildings for two reasons. They buy it because they think they can get an immediate return on their investment, a yield in other words. You can buy a preferred share and you can get a 4% yield from a bank, for example. You can buy an apartment building, riskier I'm going to suggest to you, so you've got to get a higher return on your investment. I suggest that the market is telling us, the brokerage market is telling us, that the cap rates are in the range of 5.5 to 6. And if you think about it as a progression of risk, I can buy a preferred share from a bank, which is pretty safe. I can buy real estate, which may be subject to the vagaries of interest rates bouncing around, subject to new supply coming into the market, subject to competition. All of those things are going to suggest that it's a riskier investment, so there has to be a higher rate of return. And I'm suggesting to you that rate of return is not 5.3%, which is what the capitalization rate would suggest. It's going to be higher. The other thing I'll say to you is sometimes investors buy buildings not for what's there now, but because they're going to reposition the building. They're going to do a rehabilitation, they're going to renovate. You heard me ask Mr. Wong about the fact that the Roach, Talbot, and Maxwell properties on the sales chart that the department submits to you were all sold for purposes of renovation and were in fact renovated. You heard that from Mr. Smith. I presented that on many occasions before panels as well, to the point where they're saying to me, we've heard it, we understand it, you don't need to spend time on it. But my point is, you can't look at those cap rates because that's a situation where, and I said to you at the outset, investors buy for two reasons. They buy for yield, or they buy to change the building and completely change the income that's going to be generated. So if somebody buys because they're going to change the building, you can't look at the income the building generates, because that's going to get you a higher price. With a lower income, you've got to look at the income that will be generated to truly extract the correct capitalization rate. So, having said all of that, I've said to you I've accepted the net operating income, but I think the capitalization rate has to come up. The capitalization rate has to come up for two reasons. It has to come up for all the reasons I've just explained to you about what's going on in the market, what the brokers say, the progression of risk relative to different types of investments. And as well, we know that in this case, the assessor has used a 49.29% expense ratio, even though the actual stabilized as calculated is 53.9%. We know the assessor has used an NOI of $80,616. We know the stabilized NOI is $76,481, so about $4,200 higher approximately. So the use of the NOI provides a benefit, I'll say, that's not the right word, but I'll use it, to the assessor in the sense that the NOI is overstated. If I'm buying an overstated NOI, then it's riskier. So I need an adjustment to the capitalization rate. So that's the second reason why there should be an adjustment to the capitalization rate. And what I'm asking for, and you see it at the top of page 3 of the text, so 2 pages before tab 1, you see me saying that we should apply a capitalization rate of 5.75% to the $80,616 of NOI selected by the assessor, and that results in a value of $1,402,000 compared to the assessor's $1,521,000. It's not huge, it's not dramatic, but I think it's reflective of the reality of this building, and it's appropriate in this case. And subject to questions, that's my submission.
Thank you, Mr. Leland. Mr. Wong, questions?
I have no questions.
Thank you. Mr. Upton?
In discussing the cap rate, you talked about vacancies and so on. What is the vacancy history in this building?
It's reasonable, it's good, it's not high vacancy, it's not high turnover, and I'll tell you why, low rent. So, what has, and residential tenancies, the government directed residential tenancies to take certain steps, because what was happening in the marketplace is the investment community jumped on what I'll call the rehabilitation bandwagon. They were taking buildings, the tenants were getting kicked out, they were redoing the buildings, new roof, new windows, new kitchens, dishwashers, they were redoing them, and suddenly the rents were going from $600 a month to $950 a month. They repositioned the buildings in the marketplace. So the government became concerned about that because the available housing, the affordable available housing, was diminishing because of that. And so residential tenancies changed their rules, and they made it very difficult for investors to continue to do this. Secondly, construction costs got higher. Thirdly, there was a lot of construction in the marketplace generally, a lot of competition. All of that drove the vacancy rate up. But for this property, the vacancy has been pretty good. They don't see a huge amount of vacancy, primarily because the rents are lower.
So you said vacancy has an effect on cap rates overall, but
Right.
not basically on this building?
Not on this building.
Okay. And do you know if there's been any significant renovations or upgrades? I know it's reported as 1960
Yeah.
year.
There has not.
Nothing's been changed
There
significantly?
has not, and I anticipate I'll be asked if I've been in the building. The answer is I have not been in the building. I've been in the vestibule, I've not been in the units, but I have questioned the property manager at great length about what's gone on in the building, because I need to understand that as part of this process, and this building is not upgraded.
And what does the location effect have on the cap rate?
So,
Is it not a good location, or is it
this is.
average location?
It's an average location is what I would say to you. So give me a 2.5 story walk up on Corden and River Heights, or a 2.5 story walk up on Main Street near to Leela. They're both reasonable neighborhoods, I'm gonna say to you, but I think a lot of people are gonna say you're gonna get more rent in the River Heights location than you are on the Main Street location, because of the nature of the neighborhood. Both of these, or this is a reasonable neighborhood. I'm not saying it's got a detriment in relation to that. I have a property tomorrow that's located on Isabel, between McDermott and Notre Dame, and it's got a 4.2% cap rate. That's for tomorrow, but there's an example of neighborhood where, and I think I understand where the city's coming from. I think they believe that size, number of units, tells all in terms of what the investors are doing. And I think that is an overly simplistic view of the world.
So this is not a prime area or anything of that nature,
It's
a
not
good- It's a good
Yeah,
reasonable
it's not a
area.
major crime area. I mean, we
No.
hear a lot of stories about cars in River Heights and
Oh, sure.
smashed windows and thefts, and a lot of people would
Occurs all
not.
over the city.
That's true, but a lot of people would not perceive River Heights as a major crime area, and yet there's a lot of smash and grab that goes on there.
Well, it goes on all over the city.
Yeah,
But this area is an average type of.
yeah, it's, you know where Edmund Partridge School is on Main Street? That's where these buildings are. They're right there.
That's good, okay. Okay, thank you.
No questions.
And I have no questions.
And I'll say to the panel, as I said before, the next property across the street, it's the same story from my perspective.
So we will move on to 1880 Main Street. Mr. Wong would like to take us through.
Okay, the subject property is 1880 Main Street. The roll number is 110-300-31000. It's a residential apartment block that's 2 stories high. It's built in 1959 and has 40 suites with 22 outdoor parking stalls. On page 3 is our income valuation summary. We use average rents of $708 to get a potential income of $339,000. We use a 3% vacancy to get an effective gross income of $329,000. We used a 49% expense ratio to get a net operating income of $167,000. Capped at 5.3%, we have an estimated market value of $3,155,000, which is about $78,000 per unit. On page 4 are rent comparables, showing the rents we've used are in line with what's on the market. On page 5 is a summary of the income and expenses submitted by the owner. Their estimated net operating income is $166,000, which is very similar to what the model is estimated at $167,000. On page 6 and 7 is information on how we derived our cap rates and some cap rate sales. On page 9 are some pictures of the subject property and its location. Page 10 and 11 and 12 are the income statements submitted by the owner. So when you look at the overall performance of the building, it supports the model, and the cap rate that we've used is in line with what's on the market. And I ask that you maintain the assessed value of $3,155,000.
Thank you. Questions, Mr. Newman?
Page 1 of the brief, actual year build 59, effective year 1959, correct?
Yes.
Page 3, all model driven, the valuation, correct?
I believe so, yes.
Page 5, you've done an income and expense summary, the actual, and as you've noted, the actual NOI is $166,077. The model puts it out at $167,231, so pretty close. The actual expense ratio, I'll suggest to you, is 51.13%. and the model is using 49.29, correct?
It's using 49%, yes.
49.29, okay. And page 7 or page 6, the capitalization rate chart, again, the standard chart being presented, correct?
Yes,
And page 7, also the standard chart being presented, correct?
yes.
Those are my questions.
Thank you. Mr. Upton?
No, I have no questions, thank you.
Mr. Wong, just for the record, did you inspect this property?
I did not.
Thank you. If you would like to proceed, Mr. Noonan?
Thank you. I could tell you the whole same story I just told you a few moments ago, but I'm not going to do that. My attachments are exactly the same. So I'm going to say to you that everything I said to you about what's going on in the marketplace is equally applicable to this property. At the bottom of page 2 of the text of my material, again, I've accepted the assessor's net operating income. The actual is, give or take, $1,200 less, but I've accepted the assessor's net operating income. That drives a value of $2,908,000, applying a 5.75% capitalization rate. The 2018 assessment was $2,599,000, so there's still a significant increase in value. All of my materials are the same. I'm asking that you apply a 5.75% capitalization rate to this property for all of the same reasons as the prior one. Thank you.
Thank you. Questions, Mr. Wong?
No questions.
Mr. Upton?
And the same, you've looked at this building yourself?
So in the same fashion, I've not been into the units, I've been into the vestibule. As I said, it's directly across the street from the other one. Again, I've had extensive discussions with the property manager about the condition of the building, and it's still a dated building.
Still no significant upgrades or improvements that you're aware of?
That's correct.
And vacancy runs about the same in this building?
Yes.
The history of vacancy is good occupancy then?
Yes.
Okay, thank you.
And I have no questions. We will move on to 917 St. Mary's Road. Mr. Wong, whenever you are ready.
The subject property is 917 St. Mary's Road. The roll number is 080-812-17670. It's a residential multi-use property. It's built in 2014 and has 14 suites with 20 indoor parking stalls. On page 3 is our income valuation summary. We use average rents of $1,395 for the apartment to get a potential income of $234,000. Use a 2.6% vacancy to get an effective gross income of $228,000, and we use a 34% expense ratio to get a net operating income of $149,000. Capped at 4.5%, we have an estimated market value of $3,315,000. The retail component has an estimated operating income of $21,000, and the office component has an estimated operating income of $31,000. On page 4 is information on the apartment building regarding the number of units and the premise areas for the commercial space. We have 2 units, one with 2,322 square feet and one with 1,382 square feet. The model rates applied are about $15 and $16 or $17. On page 5 are apartment rent comparables, showing the rents we've used are in line with what's on the market. On page 6 are some commercial rent comparables, showing the rents we've used are in line with what's on the market. Page 7 and 8 is information on how we derived our cap rates. On page 10 are some pictures of the subject property with its location. Page 11 is some information on the building. You can see it is a well-designed building and probably better than your average apartment building. Page 12 to 15 are the income statements provided by the owner. On page 16 is the permit that was taken out for the property. They have a total project value of about $3.2 million, but the cost of construction letter that was returned to us indicated they spent $3,450,000. As considering that they spent almost $3.5 million, I would think that they would expect it to be worth more than that, and definitely in the $4 million range. On page 18. For the commercial portion, we've applied a 2% non-recoverable expense rate. Page 18 is a sampling of properties that were, this list of properties was submitted by a different organization, and when we reviewed them, this is what the indicated non-recoverable expenses was. It was about the median was about 1.06%, and for the model we've applied a 2% non-recoverables. So it supports the 2% that we've applied. And on the bottom of page 19, for the 2020 general assessment, the median ratio for income producing properties is 0.991. Which is close to the center of the acceptable range. Basically what that's saying is that the model's estimate of values is very close, almost bang on, to what compared to actual sales. So it's just speaks to the accuracy of the model. So even though they've spent $3.5 million on the property, and you might well expect it to be worth over $4 million. In reviewing the income and expenses, they seem to be a little bit lower than what the model has estimated, and I'd like to provide a revised value.
Okay. Thank you.
So on the top of on the top box, it's indicating that their total operating income for the whole building is about $176,000, and the model is estimated $200,000, and I feel that should be reflected. The commercial income for the property is about $80,000. The model is estimated about $50,000, $55,000. But their rents are gross, so I feel that the model is pretty close. So how I calculated the apartment value was, I took their net operating income of $176,000. I subtracted the model estimated net operating income, which is $53,000, and attributed $123,000 of income to the apartment. Is that kind of making sense? And so attributing $123,000 of income to the apartment and capping at 4.5%, the estimated market value is $2,738,000. And adding that to the commercial portion, which is $888,000, I believe that is very, very close to what the property is actually experiencing. The total value is $3,626,000.
Mr. Newman?
Well, it's, thank you for this, Mr. Wong. It's a good start, but it's not there.
Okay, thank you.
But it does help narrow the issues, I will say that.
Okay.
So I guess based off of the information that, based off of the breakdown that I provided, I asked that the value be revised to $3,626,000.
Okay, thank you. So, Mr. Newman, questions?
Yes, my questions will be a little bit different in light of this than they might have been. So let's look at page 3. So page 3 was the assessment as originally calculated by the model, correct?
Yes.
And the model suggested $234,000 of gross potential income for the apartment, and you're now saying the net operating income for the apartment should be $123,207, correct?
That's my recommendation,
That's
yes.
the recommendation. Okay. Let's talk then about the commercial. So, and let's understand what's physically at this property. So essentially, you've got, fronting onto St. Mary's, 2 units entered through a common vestibule. So you come into a common vestibule, go one way to one unit, go the other way to the other unit, and they comprise a total of 3,704 square feet, correct?
That's what we've estimated, yes.
And the model says that one portion of this, and I'm looking at page 3 still, should be treated as retail. And that is the unit, looking at page 4, comprising 1,382 square feet, correct?
Yes.
And let's help the panel understand what's going on this property. In the 1,382 square foot unit is an exercise facility, a Pilates facility, correct?
I mean, if you wanted to go through the details of the property, you could explain it in your summation.
Fair enough.
Yeah.
Okay. But the reason I'm asking this is to get to the question of why there's been a split in the commercial side. So part of it is used for one purpose, part of it is a chiropractor's office. The model is saying part of it should be treated as retail and part of it should be treated as office. One part of it gets a 6.75% cap and the other part gets a 5.55% cap, correct?
Correct.
I understand that the model for office buildings has a break point where, based on size, at 5,000 square feet. So if it's at 5,000 square feet and above, then the capitalization rate is 6.55%. When it's below 5,000 square feet, the capitalization rate is 5.55%. Is that your understanding as well?
I do not know.
Okay. Do you think an investor looking to buy this property, forget the apartments for the moment, just looking at these two commercial premises right beside each other, entered through a common vestibule, one of 2,322 square feet and the other of 1,382 square feet, would take the view that the capitalization rate should be different by 1.2%?
I wouldn't know.
You wouldn't know, okay.
They may put together, they may not use one capitalization rate for office, they may not use it for retail, they may not use it for the apartment, they may have one blended cap rate.
Right.
It depends.
But the department's position, I gather, in presenting this the way it's been presented, because at the end of the day, your recommendation doesn't make any change to the commercial value,
No.
correct? Only to the apartment. So this valuation we see on page 3 with the cap rates 1.2% apart, the department maintains that position, and you're not able to assist us in why the cap rates are so different for spaces right beside each other.
Well, I guess our information is indicating that office space has a lower cap rate than retail space.
But this isn't an office building, is it?
No, but it is being used for office purposes.
Sure. Have you ever been to a neighborhood shopping center that has a doctor's office or a dentist's office or a lawyer's office in it? Isn't that premise still treated as a neighborhood shopping center?
I'm not sure.
Okay. Okay, those are my questions. I'll do it in my presentation.
Thank you. Mr. Upton?
Yeah, just show me where this $888,000 comes from, the commercial.
It's just basically the total of the retail and the office income stream. If you look on my page 3,
Page 3.
you see there's a retail income stream and an office income
Okay,
stream.
I got you.
At the bottom is the estimated market value of $312,000 and $576,000.
Okay.
It would be the total of those two numbers.
No, it's, okay, good, I see that. Just wanted to clarify that. Okay, have you inspected this building?
No.
Okay, thank you.
No questions.
So, this is a new build of 2014.
Yes.
So, in your notes, it must have been inspected at some point? Do you have
Ye-
that?
Yes, it was basically in order for us to add the property, new builds to the roll, we go out and we inspect it and we add it to the roll.
Okay.
So all new construction, we've inspected.
Page 3 of your brief, the retail,
Yes.
can you tell me exactly what that is?
The retail? It's one of the 2 units which is used for retail purposes.
But do you know what's taking place there?
I believe it's a Pilates studio. And a doctor's office.
Both on the retail side?
There's only 2 units.
Okay, so the doctor's is on the other side?
I couldn't say which side is which. I don't know.
Okay. Is this the chiropractor that was mentioned by Mr. Newman?
Likely.
Okay, that's all my questions. Thank you. Mr. Newman?
Well, I had lots to say about this, and I gave you lots of material on this, but our issues have narrowed a little bit. So let me try and peel some issues away and make it easier for you. The assessor's using $123,207 on his recommendation of net operating income for the apartment. That is actually slightly less than I am at, and it's not clear to me exactly how the assessor's gotten to that, but it doesn't matter. My primary issue on the apartment side, now that I see the adjustment in the net operating income, is the capitalization rate. So I'm gonna circle back to that, but I just wanna tell you what the issues are, so it'll be easier to follow my submission to you. Then the other issue relates to the commercial side. As you've heard me ask of the assessor, we've got on page 3 of his workup a split between the commercial space. So 2,322 square feet is occupied by a chiropractor. 1,382 square feet is occupied by a Pilates studio. These are both leases that were done within the last number of years preceding the reference date. My primary concern is this great split in capitalization rate. And I asked the assessor the question about neighborhood shopping centers, and I anticipate that many of you have sat on neighborhood shopping centers. They very frequently have a doctor's office or a dentist's office or a chiropractor's office, but they've got some office type use in them. Those buildings don't get classified as office buildings. This is not an office building. This is more in the nature of, the assessor has called it retail, but in calling it retail, when we look at the assessor's capitalization rate chart, I don't know what retail means. Clearly, it's not a regional mall, it's not a power center, it's not a community shopping center. And so if we had to try and put it somewhere on the chart, my best guess is that it's probably a neighborhood shopping center, which based on the assessor's capitalization rate chart at the 20th and 80th percentile, gets a rate ranging from 7.15 to 7.30. What I have done, and maybe easiest to show this to you by having you look at tab 7, my last tab in my materials, that's where my calculations are. So So the first page of tab 7 is the calculation on the apartments. You can see that I have a net operating income of $128,492. The assessor, through his recommendation, is now at $123,207. I anticipate that that's either by way of an adjustment to the gross potential income and or an adjustment to the vacancy ratio, because initially the vacancy ratio here is 34.67%. You can see that I've applied a 5% capitalization rate. I believe that is quite conservative, but that's what I've done, and that would create, based on my net operating income value of $2,569,000, based on the assessor's net operating income, it would create value of $2,464,000. That's an issue you're going to have to decide. Let me show you, in the context of capitalization rates, a little bit of information. If we go to tab 6, and this comes back to something I mentioned earlier. I think the department's capitalization rates are very much being influenced by the number of units or the size. Because what you're gonna see on the pages, and by coincidence, Mr. Wong was the assessor on many of these properties, what you're gonna see on these pages as we turn them is newly built buildings, which are getting a 5% capitalization rate, and we're actually getting a much higher expense ratio than the subject. But having said that, page 1, this is an independent living facility. A lot of units in this place, 180 units. Obviously the size is very different, but built in 2015, so very similar to the subject. And if you go to page 2 in the lower right-hand corner, you can see a 5% capitalization rate. As we turn the pages, 10 Hallenquist, Jennifer Martins was the assessor. Mr. Upton, I think you sat on that property. 2005, still relatively new, 126 units at a 5% capitalization rate. I should mention to the panel, these are the rates that were presented by the assessor. In fact, on all these properties, the panel assigned a 5.5% capitalization rate, but there were reasons for that. These are independent living facilities which were built for a different purpose. I'm not looking for a 5.5% capitalization rate on these apartments, but in fairness, I do want to point that out. Page 5, 3590 Portage. This is a life lease project, again, relatively new, 59 units, 5% capitalization rate. 65 Paget, same thing, life lease, 2008 construction, 62 units, 5% capitalization rate. And the last two are not independent living facilities, they're life lease projects, so they're treated as apartments, and they brought with them 43.15% expense ratios, and they brought with them 5% capitalization rates. So why does the department think the number of units should drive the capitalization rate down? I don't know the answer to that, for sure. I can speculate that maybe they think that small buildings can be an entry point for new investors, and so those new investors will often, they will suggest, pay a little bit more to get into the game, so to speak. If that's true, and I'm not sure that it is, but if it's true, I think that what gets lost in the shuffle on those things is frequently in those buildings, those new investors don't have outside property management, they're doing it themselves, and so their sweat equity is not getting calculated in any way into the expense ratios. But this is not, 14 units valued at $50,000 a door. With a $700,000 purchase price. This is a value originally of $3,315,000 for the apartments, now revised to $2,737,000. We're talking big money. That's my point. When you buy a property like this, you're not buying the upside because it's new. it's getting the market rents already. What you're buying is yield fundamentally and the possibility of what I'll call long-term appreciation. In other words, you're not repositioning the property. When you look at the assessor's capitalization rate chart, not the market chart, but the sales that the assessor includes in his material at page 8, there's those 3 that were bought for rehabilitation purposes. The only comparable, in my view, is 333 Ward, which was a 2006 building, much bigger obviously at 103 units. The city reports a 5% capitalization rate. I heard Mr. Smith earlier talk about the fact that the rate is actually higher. 333 Ward became the poster child in the 2018 assessment cycle as to what the capitalization rate should be. Doesn't matter whether it's 5 1/4, 5 1/2, or 5 even. My point is, it's not 4.5. And so there is no market evidence, I'll suggest to you, to support a 4.5% capitalization rate. So, what I'm asking you to do ultimately in respect of the apartments, the assessors come forward with an NOI of $123,207. I think you need to apply a 5% cap rate to either the assessor's NOI or my NOI, and that cleans up the apartment side of things. I could have said a lot more about it, but I'm not going to. And you heard me earlier in the last hearings with the issues relating to capitalization rates generally in the market generally, and I won't repeat all that. All right, let's talk about the commercial. So again, let's go to tab 7. Let's go to the very last page of the brief. There's my workup for the commercial property. So the chiropractor's in at $22 gross. I've taken off a $7 shortfall, and that becomes $15. The Pilates is in at $23 gross. I've taken off the $7 shortfall, and that becomes $16. That generates a gross potential income of $56,942. We are not actually that far apart on this. The assessor's gross potential income is $58,960, so essentially we're $2,000 apart. I've used the actual leases in place that were put in place in very close proximity in time to the reference date, so I think those are reflective of the market. I've used the 6% vacancy, one vacancy, not 2 different ones. I've used the $6.50 per square foot shortfall. I've used an additional non-recoverable of 5%, so that turns into 7%. I don't want to spend a huge amount of time on this non-recoverable issue. I'm not giving you a submission on non-recoverables, I don't think. No. But I only want to say to you this. The assessor's 2% allowance, which you find on page 3, based on his rents, comes to $1,112. And remembering that non-recoverables are the money you can't get back from your tenants. So $1,112 isn't going to go very far, I'm going to suggest to you, in terms of having to do the roof, even of the commercial space. Let's take 3,700 square feet of commercial space, never mind the apartments. We have to do a new roof, $12 a square foot. That's over $40,000. The assessor's allowing $1,112. It's going to take 40 years to get that back. You'll replace the roof twice in that time frame. Never mind legal and audit, never mind leasing commissions, never mind other structural repairs, never mind all that. My point simply is that $1,112 isn't enough. What I'm asking for in total is about $3,700, and I'm urging you to allow that. And then the last issue then becomes the capitalization rate. My net operating income becomes $48,334. I'm applying a 7% capitalization rate, whereas the assessor has split the capitalization rate 5.55 to what's called the office portion, and 6.75 to the retail portion. About all that, I say to you simply, I don't think an investor is gonna look at these two units, these 3,700 square feet beside each other, and is gonna treat one as an office at a 5.55 cap, and the other is retail at 6.75. I think the investor is gonna treat this the same. This size breakpoint, which I think is 5,000 square feet for commercial, and brings the rate down to 5.55 for small commercial space. I don't get it, frankly. When you look at the assessor's chart, you see strip malls at 6.4 to 7.05. You see neighborhood shopping centers at 7.15 to 7.3. You see the brokers talking about neighborhood shopping centers at 6.5 to 7, strips at 6.5 to 7.5. I think I've been quite conservative in using 7% overall, and that would drive a value of $690,000 for the commercial space compared to the assessor's 888. So, at the end of the day, what you have to decide is the following. Which NOI are you gonna use on the apartment? My NOI of about 128, or the assessor's NOI of 123. What cap rate are you gonna apply to that apartment NOI? I'm suggesting not less than 5%. On the commercial space, the assessor's value really remains unchanged from what was originally presented, which is the two income streams. Our gross potential incomes, as I've said to you, are about $2,000 apart. I think you should use the actual in place. What we're then coming down to is the capitalization rate. I've used 7 across the board. The assessor is at different rates. A lot of paper here, looks complicated, but in the end, I think actually the decisions you have to make are relatively few in number, and I'm open to questions.
Thank you. Mr. Wong?
That was a lot.
But I summed it up at the end. So that's what you gotta focus on.
I was just wondering, like, in terms of how you calculate your net rate, you calculate it by removing the $7 shortfall?
Yes.
I'm not sure if that's how shortfall rates are used.
Well, so let's talk about that. So, what is shortfall? Shortfall is the amounts that a landlord would typically recover from a tenant.
For vacant space.
No. Recover from a tenant when the space is occupied, but because the space is vacant, what is typically recovered from a tenant is not available to the landlord, so the landlord eats it in essence. It comes out of the landlord's pocket. So that's where I got the $7 from. Because this is the amount that the landlord would typically have to pay himself. In other words, it's the additional rent and leaves intact the base rent. So that's how I got to the $7.
Okay. That would be all my questions.
Thank you. Mr. Upton?
And so in total, you're asking is the right number of 3,260,327?
If you're using my NOI on the apartment building as opposed to the assessor's NOI and at a 5 cap, that's correct.
So the total of the building is 3,260,000.
Using my NOI on the
Yep.
apartment building.
Right. Okay, that's what you're asking for. Well, the apartment building on the rentals,
Yeah,
did you use the actual rent?
right. So, and I didn't.
1308.75 per suite?
Yes, and I can show you how that's arrived at because I've included a rent roll in my materials. So I'm happy to walk you through that if you wish. Because we were really coming down to a $5,000 difference in NOI on the apartment building, I didn't do that, but I am happy to do that.
Yeah.
So if you go to tab 2,
Well, you're okay with that then? Tab 2, okay?
tab 2 is the rent roll. And if you go to the 3rd page of the rent roll, you can see that what I have done is I have taken the total monthly rent of $25,523. I subtracted Pilatus, I subtracted the Cairo, which brings us down to $18,322, so that's the rent for the apartment portion. I divided it by 14, which comes to $1,308.75 per unit per month.
Okay. Um, So do you ever deal in a blended cap rate for a building like this?
Well, in a sense, we are.
You're arriving at a blended cap rate overall then? Yep.
That's right.
Because nobody's gonna buy
Well,
individual cap rates, but
But-
to arrive at a value, you.
But I think an investor would go through, a disciplined investor would go through a process of looking at the apartment side of things, because that's really a different operation.
Yeah,
And properly calculating a value in the traditional income approach. But I think on the commercial side, I don't think they would, these two spaces right beside each other, entered through a common vestibule, I don't think they would separate them in terms of
No.
valuation.
no. Okay, thank you.
Questions? Yeah, and this is probably following up. There's nothing in the build of the office versus the retail that would limit the use to one type of.
So, you know, it's interesting you asked that question, because I actually am way too familiar with what went on in that building, because there's been some litigation over it, and the contractors and the work that was done. But, you know, I mean, imagine if you will, what a doctor's office or a dentist's office, or any professional office looks like. You've got a common waiting area, and then you've got a storage area, you've got a receptionist desk, and you've got some offices, exam offices, I'll call them. How do you get to all that? You put demising walls in. So it's got some drywall. Could you take all that drywall out and turn it into something different? Sure you could, absolutely. The Pilates space, it's got some flooring, it's got some mirrors, it's got some sound systems, but other than that, and it's got some change rooms and some washrooms, but other than that, it's really a big open area. Or the majority of it is.
Okay.
So they're readily changeable to something else, which I think ultimately is your question.
So so I am clear, tab 7, you are asking for the 5% to be added back in.
The 5% non-recoverable, that's correct, on the commercial.
I'm assuming then you've inspected the property.
Yes.
Okay. Can you speak to the office finishings, or the finishings in the Pilates studio?
Well, again, at the Pilates, as I said, is a good chunk of it is open area, because it's classes.
Right.
But there is change room, there is washrooms. The Cairo space is, I mean, it's not overly fancy space in the sense that, you know, it's really in many ways no different than this. It's drywall, it's painted walls, it's a reception desk.
Okay, thank you. That's all my questions.
Sorry, I guess, just a quick summation.
Yes.
Yeah, okay, so we've been presented with a lot to consider. But I think what we're here to try to determine is the market value, and the applicant is presenting a market value of about $3,260,000 or so. And I'm suggesting a revised value of about $3,006,000 something. The property owner spent at least $3,450,000 on the property. It would be easy to think that they would expect it to be worth, say, $4 million. And so if that's kind of approximately a reasonable market value for the property, then you know, the approach, we've taken, I guess, very different approaches, and there's a lot of considerations from the applicant, but in the end, with regards to the actual value of the building, the revised value that I'm recommending is probably low, but it's closer to the value of the actual value of the building, whereas the value that the applicant has presented is actually less than what they put into it. And so that doesn't really it just leads me to think that the approach that we've taken is accurate, and I ask that you accept the revised value that I presented.
Thank you. Mr. Newman?
Buildings are built for their economic life. That may be 50 years, that may be 100 years, and therefore their cost of construction is not a fair indication of their ultimate value. Their value is determined by the marketplace. There's a little thing in Toronto called the Sky Dome. The first person who built it spent $600 million. The next buyer paid $125 million. The third buyer, Rogers, when they bought it, paid $25 million. Heckle Island Resort, same thing. What frequently happens is the value isn't always there because the economics of a property may not allow that value, that construction value to be there. We're not doing the cost approach here. If we're gonna start doing this based on a cost approach, we can do that. Really, that's what Mr. Wong, I think, is saying to you, is it costs this much to build, and therefore it can't be worth less, and Newman is asking for somewhat less, and that can't be. Well, I think it can be based on what the numbers are, and that's what I'm asking you to do. Thank you.
Thank you.
And we got done in a timely way.
You did. Thank you.
Would I be able to take a quick washroom break before we finish up with the remaining properties?
Oh, yeah, I forgot about those.
Sure.
I know.
Call this hearing back to order. Mr. Wong, if you can just take us through these last two properties, please?
Sure. The subject property is 2 Old Commonwealth. Is that the, yeah, okay. Is 2 Old Commonwealth Path. The roll number is 140-995-96000. After reviewing the property with the applicant, I'd like to recommend a revised value of $6,560,000 based off of a revised net operating income of $327,995.
995?
Yes.
Did you get that, Carol?
6516.
Thank you. Panel, any questions on that?
No questions from me.
Did you, and you discussed that with the owner?
Yeah, I can give you an email if you like.
You approved it?
Yeah.
He was fine?
Yeah.
Oh, there it
Can I take 2 of these ones for each file?
Sure, you can, yeah, take it.
Okay, thank you.
Is that going to be public record?
If you hand it out.
Yeah.
Is it okay if I keep it then?
Sure.
I guess I prefer not to have the email communications. Sorry. But the applicant was agreeable to these values.
Sometimes it's just a recommendation.
Yes.
Okay, and our next property on Layla?
Yeah, the next property is 535 Leela. The roll number is 110-510-63000. And same thing, I'd like to recommend a revised value of $7,418,000 based on a revised NOI of $370,906.
Upton, any questions?
No, no
regarding
question.
this? Ms. Leslie, questions?
And again, accepted by,
Yeah, they were both on there.
oh, they're
Yeah.
both on the
Yeah,
same.
yeah.
Just one quick question was, did you inspect the property with the owner? Is that?
No,
No.
Just- it's just regarding
Just
the
a
additional
discussion.
information, yeah, the applicant's information that you provided. So I just wanted to double check the numbers with you guys, just to make sure.
Mhm.
Sure. 7,418,000?
Okay, and for 2 Old Commonwealth?
6560.
Yeah.
Yeah.
6560.
Yeah,
Yeah.
okay.
Great. Thank you very much. And this hearing is closed.